All right, thanks for taking us through how traders poised this Friday afternoon. You can actually see how that volatility has sort of affected the markets right there. Let's get in our guest for the show. That's Arun Thukral. He's the MD and CEO of Axis Securities. Thank you very much for speaking to us this Friday afternoon. Arun, my colleague was just taking us through the markets at this stage. We've, of course, seen the kind of profit booking that has settled into the stocks, as well as a bit of choppiness that you're looking at. Given the kind of run-up we've seen so far, how do you see the markets panning out in the short term?
Thank you, Padma. And first of all, let's be happy that we touched 10,000 mark in Nifty. And profit booking obviously is a healthy sign. But with this 10,000, we were just looking at different things. So one difference this time is that a lot of Indian investors have put in money, whereas all our earlier highs we used to look at FII only. But if you look at this time, the money which has come from January to June, the net inflow in mutual fund is around 26,000 crore, which was 8,000 crore last year. So I think first time we have seen our independence from FII inflows. So obviously FIIs are important and they are also putting money. The second best thing has happened this time because of initiatives like demonetization and GST. Lot of money has flown into financial assets, and that is showing. So that money is also coming, and first time we have seen that at a new high, many people are actually welcoming this correction. They were all sitting on money, and now because some profit booking is happening, they are happy. They want to buy good stocks. So these are the good things happened. Even if you look at the valuation, it may be 10,000 or 9970, but if you look at last high in 2008, when Nifty touched around 6,200, that time the Nifty earnings were 222, and now it is around 454, which is more than double, and we are at 10,000. So it is not frothy valuation. We still find a lot of juice left, and there will be sector rotation. There will be people who will be buying their blue chip stocks whenever the market corrects, and there are good pockets where the money is still there.
Now, when you're looking at good pockets, what's the kind of advice that you're doling out to investors who work with you to be able to strategize better for the long term? Right now, like you said, there needs to be a churn. This rally has been more or less liquidity driven, and if that continues to be the story, more upsides can be expected. But like we've been hearing from you and other experts, you need to be stock specific. You perhaps need to stay with the blue chips. So in terms of strategy, what are you advising your clients?
So I agree with you. Now, for a long term, it is still looking very good because there are a lot of structural reform which have happened. Good monsoon again in the second year. Now we have two kind of investor. One is a retail investor who has very little money, and so our advice to that investor is don't time the market, and because this investor is investing for a longer term. So whenever they have money, whenever and whatever SIP they have, we are telling them to continue. The second set is the HNI who have got some kind of a timing always. They want to do some kind of a timing. So we tell them don't invest surplus money, be ready with your money, and whenever there are some corrections, there may be opportunities which comes every year. Last year it may be in the form of a Brexit or a demonetization or a Trump victory or a surgical strike. So this year again there will be trigger, there will be opportunities to be ready with your shopping list and go and buy the sectors and stocks which we keep on advising them on a very regular basis. So that is the strategy. And if you are want to know what we are advising the sectors, so we are primarily as of now telling about auto and auto ancillaries, primarily auto ancillaries, because they are not only supplying to the Indian listed company, they are also exporting, they are also supplying to the global auto majors who have set up their hub in India. So they are better placed. We are bullish on the consumption play because of the second good monsoon. There are people who have got money, who are buying things, and because of GST, a lot of branded plays have become very attractive because even the unbranded play, they got into GST, they have to pay taxes. So the branded player benefits. So formalization of industry is happening. So there are, and then there is housing for all theme. So there are always demand for good housing finance company, primarily low ticket and mid ticket kind of players. and even cement companies, because all the ancillary plays will benefit, whether it is sanitary ware, whether it's plumbing. So all these people also will benefit. So these are the pockets where there is value left. So that is what we are advising.
Okay, I'm going to ask you to hold on to that thought, because we've, of course, been talking about the kind of beating that Dr. Reddy's has taken. It's really been the top loser in the Nifty today. This is after the disappointing quarter that we saw. Even the management outlook didn't do anything to really lift the investor sentiment there. Let's listen in first to the company's COO.
You know, the first thing is U.S. market is the price pressures are still on. The reasons for the price pressure, we have explained the consolidation of the channel, the three major players. So that's probably one of the major headwinds. Appreciated, very welcome change in certain ways, but for exporting industry, it is hit. I mean, US being very major revenue, not just for us, most companies, I think the headwind and the pricing has an impact, and we are seriously looking at our cost base in a very serious way.
Well, that's a word coming in from the management at Dr. Reddy's Laboratories, on the back of which brokerages have spoken, and certainly they aren't very impressed with what's going on at Dr. Reddy's Laboratories. So let's find out from Piyush, my colleague in the research team, what exactly they're saying about Dr. Reddy's Laboratories, what the future looks like. Piyush, what are you hearing from the reports that have been coming in on this counter?
Well, consensus theme is that most of the brokerages, they are highly unimpressed with the results, and also while some brokerages have in fact also changed the ratings, but the target prices cut is almost a common theme across most of the brokerage notes. Let's start with the first one, the CLSA. Now there is actually the rating change is a direct rating change to sell rating from buy rating, which is in fact a big rating change. Target price has been cut to 23.90 from 32.80, again a large target price cut here, and that actually indicates a negative vote of confidence from CLSA. Now, although they basically have cut the FY18 and FY19 earnings estimate by 32 to 43%, and they're saying that this result was the worst ever quarterly result in many years. Now, what did not work? Now, there are 3 pointers which they have indicated. The first one is higher than expected price erosion in the US markets. We know that a lot of pharma companies, they have been reporting price erosion anywhere between 50 and 30%. So again, for versus expectations, CLSA actually saw that for the US market, it was a large negative setback. Also, a low contribution has come from the recent US launches. And the third one, GST destocking, basically that has negatively impacted profit margins. Now, what was very interesting in the report was that CLSA is saying that whatever recovery efforts the management is talking about, that is actually going to produce results only in FY19, which means the next 3 quarters. At present, the analysts are not gaining any confidence. And lastly, the drug launches which are going to come in the FY18, they actually are going to be very critical for any sort of re-rating the stock can see. The addressable market which the 3 drugs are going to address would be roughly $3.7 billion. So perhaps that could actually change the stock view. The next one very quickly is Credit Suisse. Again, 2% sales miss by them. 40% EBITDA miss according to them. What they actually are saying that the margins actually were very weak, perhaps could be a one-off, but EBITDA actually was already 20% as per their estimates, below the street estimates, and then also Dr. Reddy basically has missed their estimates. Now what they're saying is that plant clearances is actually very critical, even for reaping benefits from the future drug launches. The last one again, Prabhudas Lilladher, again has a target rating of 2075. So across the 3 brokerages which you talked about, the target ratings are somewhere between 2000 and 2400. Again, substantially down from what the current stock price is. And again, the PL is saying the same thing, is that destocking, then headwinds in terms of price erosion in the US markets, and also they believe that the US revenue estimates are going to erode further in FY18, which means overall, if I'm summarizing it, US markets as the biggest headwind. FY18 is not looking encouraging to the brokerages, and this actually is basically giving good uncertainty in terms of revenue outlook, and that's why you're seeing big cuts in target prices today.
The ogre of uncertainty seems to be rearing its ugly head on the pharma sector. So every few days we have these patches where we're saying that, look, the clouds are kind of going away from the pharma pack. And then again, you get the kind of earnings reports perhaps or a US FDA concern. And then again, we are retracting on that particular sector. Arun, what do you make now of how an investor should look at the pharma pack? Because look at the kind of brokerage calls on Dr. Reddy's Laboratories. Would you think that among the contrarian calls that you can make in today's markets when you're looking for okay valuations, perhaps even to enter that space, would you look at the frontliners or would you go with the mid caps within the pharma packs? Which are your picks? What do you like, if at all, anything in that pharma pack?
So pharma sector, as you said correctly, this is in and out of troubles. Maybe few days back we were looking at pharma pack and we were saying maybe they are coming out of it when we looked at Aurobindo Pharma, when we looked at the results recently, Glenmark and all. But again, when you look at result today, as you said, Dr. Reddy, we have seen. So as a sector, we are underweight. We are very cautious on pharma and as well as IT. Because we feel that if there are other sectors available, so why to get into, maybe we will wait for some time and then get into any stocks. If there are people who are getting into a basket, maybe that's a good strategy. But stock specific, we are not at all bullish as of now.
Right
so
there,
we are avoiding this sector.
Sure. Arun, just hold on to that thought for a minute, because I'm just going to ask you to hold on a minute, because we're just getting some news that Karur Vysya, of course, has posted their Q1 numbers just a short while ago. Concerns on those asset quality as well as provisions and NPAs have gone up. And joining us just on the phone line at the moment is the CEO and MD of the bank, that's K. Venkatraman, to give us a fine print of the June quarter gone by. Mr. Venkatraman, thank you very much for coming in to speak to us. First question really is that we see that asset quality appears to have worsened a little bit. There's also been a bit of a spike that we're noticing in the NPAs. Is it due to any one particular account?
Asset quality has apparently deteriorated because of slippages in the corporate account, which was on the expected lines. Even after our annual results were declared, when we had interaction, we have indicated that we may have about 600 to 650 crores of weak accounts, which are likely to slip in case resolutions do not happen. These are accounts which were under various types of resolution processes, such as SDR, S4As and things like that. Now, what has happened in the first quarter, we also indicated at the time that Q1 and Q2, it may be slightly remaining escalated because the slippages or the resolutions are supposed to come during these quarters. What has happened, a few accounts have slipped, about 200 crores have slipped out of the 323 crores of net slippages that have happened during the quarter.
323 crores of net slippages, Mr. Venkatraman. Any exposure to the companies on RBI's list of 12 companies, the companies that we are calling the dirty dozen, the cases that are before the NCLT? Do you have any exposure to those?
Yeah, we have a couple of them. 2-3 accounts are in that list.
What would be the total sum of the exposure that you might have to these companies, Mr. Venkatraman?
The most important point is that how much we have to provide, because 50% has to be provided in case they are admitted to NCLT. We already have provisions in most of these accounts, and a few cases, if they are admitted, then we need to make some provisions, which we will be in a position to make it very comfortably.
Okay. Mr. Venkatraman, just a little bit more in terms of the size of the SMA2 book, and also is there some sort of risk of incremental slippages?
What we expect is, as I said, out of the 600 crores, which are under resolution process, 200 have already slipped. Another 450 crores are facing resolution processes. If the processes go through, because today RBI has taken a stiff stand and they are now armed with the powers of directing the banks to complete the resolution processes. If the resolution processes are completed, these accounts will be out of the woods. If they are not completed, they may probably slip. What kind of resolutions can happen and what kind of provisions that will be required, though we are not very sure, but then the kind of provisions that are required, we will be in a position to substantially absorb. The reason why I am saying this is, and the confidence we gain mainly because the bank has been showing strong earnings growth. And if you see our net interest income, it has grown by 12%, and other income has grown by 46%. Even if you take the other income other than the treasury income, it's around 28.5%. Operating profit has grown by 29%. So we do expect, as we go along, we should be in a position to have enough of profits, and net, the provision requirement will not be that high as it has happened in the last year also. Another thing, what we have done is we have created special structures for recoveries, focused recoveries, which will take care of the recoveries. We do expect some good recoveries that have to come back during the second, third, and fourth quarter. With all these things put together, we are confident that the provisions requirements may not be much high, but we will build up the provision coverage ratio from here on so that the net NPAs will come down.
The net NPAs perhaps in the second and third quarter may come down, Mr. Venkatraman, but like you pointed out, earnings growth is there. You're looking at the kind of gains within the treasury side of the business as well. But the kind of provisioning that might eat into that earnings growth, we want to get more specificity in that, if you can help us with that. And perhaps it would be highlighted by the kind of restructuring that you might have undertaken in this quarter. What can you tell us about that?
If you look at the provisioning part of it, last year we had made the total loan loss provisions of about 688 crores. In spite of that, we made a profit of 606 crores. During this quarter, if you see, we have actually made a provision of 233 crores for loan loss provisions. Still, we had maintained our net profit at a flat level of at least 147 crores. So what I am trying to say is that because of the strong earnings growth, and we do see growth actually coming in because advances growth is picking up. We found the advances grew at around 8% compared to 5.8% last year. And particularly in the commercial banking area, which is MSME, the growth has been slightly better than what it was last Q1. The trend is expected to continue. With that, even the provisions are going to eat into our profits, operating profits. The operating profit growth being stronger and the provision requirement for this year being lesser than what it was last year, I think we should be in a position to build up very decent growth on the net profit also in the second, third, and fourth quarter. Second quarter could still be slightly, the NPA levels may be slightly escalated. We may make some provisions. If you see in Q1, we have made 233 crores of provisions. This kind of provisions may not be necessary is what we take a call. And even if it is happening at a slightly higher level than what it used to be there in the past, it should be in a position to comfortably absorb that.
Mr. Venkatraman, just before we let you go, what are your expectations from RBI when it comes to forthcoming policy? Are you expecting a rate cut? And how helpful do you think it's going to be?
I feel that there is absolutely no need for a rate cut because RBI has got enough of liquidity. RBI may probably adjust the liquidity in keeping the interest rates, if necessary, lower. And it is not necessary that they should cut the interest rate for bringing down the interest rate in the system. They have the other tool that they can easily use.
Mr. Venkatraman, also just before we let you go, as far as exposure to the corporate sector is concerned, now what's going to be your strategy going ahead? The kind of issues that we have on the NPA front, and that's not just with your bank, but across the PSU banking space much more than the rest. How are you going to change strategy now as far as loan growth is concerned? Are you going to cut down on the corporate side and concentrate much more on retail? What's the outlook on that?
Our corporate loan definition.
We seem to have lost connection with Venkatraman, but that's going to be an important one to track, and perhaps we can re-establish connection and get that information from him. But for the moment, we will take a little breather. We have our guest, Arun Thukral, with us from Axis Securities to get you more perspective on the kind of stocks and the stories that we are tracking right now as far as markets go. So do stay with us. Up next, we continue to put the spotlight on the movers and shakers in trade. So that's right as soon as we are back on Lunch Money. Don't go away.
Still watching Lunch Money this Friday afternoon. Let's talk about what's been happening at ITC, because we've seen how it's cooled down a bit after posting a steady Q1. CLSA has upgraded that stock, in fact. Let's in fact go across to Shell, who's going to talk to us about what the brokerages have made out of the numbers that we saw from an ITC. Shell, just take us through what the various brokerages are saying there when it comes to this company.
Right, so when you're looking at ITC overall, the one number that the whole market was anticipating was the dollar revenue, was the volume growth number. And if you look at the volume growth expectation, it was expected to be down by 2 to 3%. Now, the volume growth which has actually been delivered is close to 1 or 2% in the positive. So it is definitely better than what the street had anticipated. I'll run you through a few of the brokerage houses and what they have to say on the stock. As far as CLSA is concerned, they've gone and said that the operating performance was broadly in line despite a strong cigarette volume growth. The stock is pretty close to the price target, which is of 285 rupees per share. Cigarette volumes rose 2% year on year, and their estimates of cigarette volume growth for this quarter was pretty much on the flatter side, but it's still done better than their estimates. They've upgraded their rating to an underperform from a previous sell recommendation that they had, and they say that 30 times 1 year forward PE, ITC trades at a significant discount to its peers. Morgan Stanley has gone and said that GST-led down stock did not impact the cigarette business materially. The company has gone and reported over 1% kind of a volume growth. Cigarette volumes are in line with their estimates, and the management is likely factoring in 3 to 4% decline in cigarette volumes after GST. And they have an equal weight rating on the stock currently with a price target of 285 rupees per share. Third one is a view coming in from Nomura. They've gone and said the first quarter earnings were largely in line with their estimates. Cigarette volume business growing steadily with a 6.5% revenue growth, and FMCG business reported a strong 9% revenue growth. Stock trades at a P multiple of 24.6 times on FY19 EPS. They maintain a buy on the stock. The price target is 356, one of the higher price targets that we have seen, and they continue to prefer ITC in the consumer space.
Shel, thanks for taking us through all of that. So overall, what we're really hearing from these brokerages is that they seem to feel that the company has sort of managed the headwinds pretty well, and we're also looking at some kind of a relief that investors are sensing after the GST scare that we witnessed. Arun, I just want to come back to you on an ITC. Do you remain positive on this particular stock? And of course, overall, there's much buzz around FMCG as well. But what are your thoughts on ITC in terms of where we are and the kind of levels that one should track when it comes to that company?
So ITC obviously is a very good company because over a period of time, people have got that credibility. Now they have two businesses. One is obviously cigarette business, which is the mainline business, and other is the FMCG. So as far as FMCG valuation, it is a cheaper stock. So that's why people come very regularly and buy and always say that FMCG, if you get the FMCG valuation, then one should get into ITC. And after this GST implemented, the stock got a fill up, and later on it corrected when the duty was increased. So now, after looking at the results, if the volume growth is happening, so maybe 1 or 2 quarters, there will be people who will be watching the volume growth. But I think it is a reasonably good stock, and if one has to keep it, it obviously is to be part of the portfolio. As far as FMCG as a pack is concerned, even HUL has given good results, and the profit was around, I think, 9.2%. Although volume growth was not as per the expectation, but the sum of the stock has taken a beating because of the GST, destocking and all. So maybe that's why Asian Paint or maybe Pidilite, they have not come out with good number. But per se, overall FMCG, we are very, very positive as a sector, because the consumption is going to play, because people have got money. People, after the demonetization last year, the monsoon was good, but people could not spend because demonetization happened. This year again, there is a good monsoon. So people have money. So people are going to buy things, and obviously FMCG sector is going to be the main beneficiary of this buying.
So consumption theme remains intact more or less, and of course you need to get stock specific. So you're saying for the moment ITC is looking strong, but of course from the unorganized sector the competition still remains with the kind of hikes that we are seeing on cigarette prices, and that perhaps with the added cess etc., how much of that burden is going to get passed on to consumers and how much that weighs in on the margins eventually, and the volume growth is something that we'll have to track very closely on ITC. But for the moment that's that. Then even the mighty HDFC, as we were talking about the NPA issue in the banking sector, now the mighty HDFC has also disclosed that it had lent 903 crore rupees to Essar Steel. Essar Steel, of course, just to remind you, one of the 12 companies, the dirty dozen that has been referred to the insolvency club by the RBI, and this has pushed up the NPA for HDFC in the current quarter as well. Now, the management says that adequate provisioning has been made for the exposure that it has to this particular company, to Essar Steel. Listen in to what we heard from them.
We have no exposure to Essar Oil. It is only to Essar Steel. Now, Essar Steel had approached us. NHB allows us to do non-housing. Housing must be 75% of the component. So we don't even have 5 or 10% of non-housing loans. But that time when Essar came to us, they were doing exceptionally well. And there was this new steel plant coming up in Gujarat, Hazira. And we gave them money for construction of a large housing colony for their employees, construction for their office, factory, only the construction side of it. Now, the good news is till March, our installments were coming. They're not an IPO till March. Till March, they paid us. April, May, June, 1 quarter we've not been paid because State Bank has filed an insolvency, so why should they pay now? Rightly so. But they have, the proposal they've made to State Bank and the consortium of banks is that we can service 70% of the loan, not 100% of the loan. 65% of the loan we can service with our existing operations very easily, and 5% equivalent of the loan we will give you equity. Now the banks have not accepted that, so it's gone into insolvency. Let us see what happens. So it's not a 100% write-off, 70% offer is there. There are other companies in India who are interested in buying Essar Steel at a better valuation. So I'm very hopeful that we may have to take a small amount of haircut, but on the whole it's a good plant. It's a steel capacity in Western India. Very few steel capacities are in Western India, and it will do well, whoever takes it, or whether Essar improves a bit.
Non-performing loan number has gone up in this quarter, but the only reason the non-performing loan has gone up is because one of the loans which RBI has referred to the insolvency court, we had given a loan to Essar Steel, which has been classified as a non-performing loan. If we exclude the Essar Steel loan, then the gross non-performing loan number in June would have been 0.80% compared to 0.79% in March. So it has remained more or less the same. In comparison to the regulatory requirement, we carry an excess provision of as much as 504 crores. Now, if you break up that regulatory requirement of 2,646 crores into what pertains to standard assets and what pertains to non-performing loans, the breakup would be as follows. For standard assets, the provisioning requirement is 1,667 crores, and for the non-performing loans, the provisioning requirement is 979 crores.
All right, so KK Mistry there, he's of course telling us why when it comes to HDFC we're seeing the kind of NPA spike, and he's very much talking about an Essar Steel as well right there. Let's switch tracks now and talk about how the likes of Tesla and Volvo perhaps should watch out. We understand that there's going to be some major competition with Indian auto majors readying themselves really to take on the electric vehicle technology opportunity that exists at this moment. While Mahindra is the only company that sells an electric car in India currently, Tata Motors has also prepared a significant plan for 2018 in the e-vehicle space. My colleague Swati is here to give us more details on that. Swati, sounds very, very exciting. Just take us through what these companies are actually looking at when it comes to the space.
Well, electric vehicles is the new buzzword forward, especially after what the government of India has announced of making sure that by 2030 all vehicles that we drive or are driven in are electric vehicles. So clearly the push is coming in from there, and as you know, we were talking about some of the global companies who already have technology have to just bring in those products in India. Of course, costing is something that they're figuring out, but what's important is Tata Motors, which we know right now do not have any product in the electric vehicle space, is now actually ready with a product which will be actually launched only next year and will be unveiled sometime in September. In fact, to be precise, 6th or 7th of September is when they will showcase their Tiago electric vehicle. At the Auto Expo last year, they had shown a concept of a bold electric and which could run for 160 kilometers on one charge. So they showed their interest there. Now, we know as a matter of fact the kind of strategy they are putting in place. One, they have already invested about $1 billion in this technology, and they are going to pump in even more. What they're going to do is obviously not stop with one, but bring in an array of vehicles in the electric vehicle space. So you will have in fact, what I understand is that at this point in time, they're also testing a nano electric, which perhaps could be used with Ola on a share taxi basis. There's also some bit of talks that are going on them rolling out a fully electric bus. So they are expanding this technology across their product range. Slow and steady is the approach that they are taking. Also, very importantly, JLR is what they're working with as a team to see what they can sort of work together and integrate that technology. Of course, application is going to be completely different. For JLR, their different product and the range and so on and so forth. But the preliminary integration is something that they are together working on. And this is something that they believe and the company believes will be just the start of it. 2018, first Tiago electric vehicle, and then it will follow with a whole host of products. So big plans really for Tata Motors in the electric vehicle space.
Yeah, absolutely. And this is, of course, at a time when we're hearing more and more about that desire to really go very electric when it comes to the near future. Swati, thanks for taking us through those exclusive details right there. Aruna, just before we go and end this conversation with you, really a little bit more in terms of any kind of opportunities you see given these kind of initiatives that we're looking at. I mean, there's been so much buzz about going all electric by a certain period of time, even years such as a 2030, which is really not that far away. Do you think there's some opportunities that one should really be looking at given the fact that we're trying to embrace these sustainable technologies?
See, I think it's too early to comment on that because it will obviously take time, and we can see initiatives all over the world, and there are many countries who are working on these initiatives. But as far as India is concerned, maybe as of now the auto companies are doing very well, but at the same time we have to keep our eyes and ear open, and maybe at some point of time we have to take a call. But as of now the auto sector is doing very well, and we should not worry too much about this. Technology will definitely, over a period of time, you have to accept the change, because change is the only thing which is happening all the time. So if we keep our eyes shut, then there is going to be an issue. But as of now, there are a lot of other opportunities, lot of other sectors. Maybe I talked about many sectors. Textile can be another opportunity. So there are a lot of pockets where people can make money, and at the same time keep our eyes and ear open. And if there is any change happen, we have to be conscious of that, and we'll take the call at that time. As of now, we are not unduly worried about this electrical vehicle. Yes, that is what I
worried about electric vehicles, but now going ahead from here, how much that's going to change the course of the auto industry, which has been an outlier as far as performance goes, in terms of being able to deliver value to minority shareholders within an entire range of stocks. And you did mention the auto ancillaries as well, and we've seen traction in the tire space as well, thanks to the input costs that have gone down quite substantially. So yes, there is much to expect in the auto industry and the other pockets that you mentioned. Thanks very much for joining us with your perspective on the markets. That's Arun from Axis Securities giving us that all-important look at what we can expect from the markets. Currently, we are at 99.57 on the Nifty, and you're seeing some of the big financial names like a Yes Bank and an HDFC and an Indiabulls Housing Finance. They are still holding fort as far as these markets are concerned. We continue to track them, but then also we are looking at the big news across the border. There is the verdict that's come in from the Pakistan Supreme Court on the Panama case, which is actually disqualifying Pakistan's Prime Minister Nawaz Sharif from office. What are the implications of this? We'll discuss that with the Editor-in-Chief of Financial Chronicles, Sandeep Bamzai, joins us on the flip side. Do stay with us.